You're syncing up and tuning in to the Lending Link podcast, powered by GDS Link, where the modern day lender can dive deeper into the future of data, decisioning, and credit risk solutions. Welcome to the show, everyone. I'm your host, Rich Alterman, and today we're syncing up with Saddlebank's Josh Williams. Josh holds the title of EVP and Chief Banking Officer and the head of Partner Banking. Josh has his MBA from the Michael G. Foster School of Business at the University of Washington and a BA in Economics and Political Science from Macalester College in Minnesota. On this episode, Josh and I will delve into banking as a service, commonly referred to as BaaS, and discuss topics such as how BaaS is different from the traditional banking models, why Seattle Bank implemented a BaaS solution, collaborating with fintechs, marketplaces, and brands to integrate financial services into their customer experience, and so much more. But before we dive into the interview, please head over to GDS Link's LinkedIn and Twitter pages at GDS Link and hit those like and follow buttons. If you had not done so already, please subscribe to the Lending Link on Apple Podcasts, Spotify, or wherever you prefer to listen to your podcast. And for additional insights around banking as a service, GDS Link recently published a comprehensive ebook entitled Navigating the BaaS Landscape, which is filled with best practices for those organizations seeking to acquire and integrate a BaaS solution into their business. Download a free copy today at info.gdslink.com/navigating the BaaS landscape. Once again, that's info.gdslink.com/navigating the BaaS landscape. You can also access the ebook directly via our show notes in the episode description. All right, now let's get synced with GDS Link. Welcome, Josh. Hope you're having a great start to the week. Where are you joining us from today?
Yeah, hey, thanks, Rich. Great to be here. Had a chance to work with your team and recently had a chance to listen in on some of your podcasts, and it's been a great resource. So glad to be here. I'm joining you from Seattle, our world headquarters.
Thanks for joining us on a Monday afternoon. So, Josh, you've been with Seattle Bank now since 2014, almost 8.5 years. How long have you been in your current role as head of partner banking, and what does that role entail?
Yeah, time flies. It has been over 8 years with the bank, and became head of partnerships over a year ago when we decided to launch our partner banking business, working with fintechs, marketplaces, and brands that want to offer financial services to their clients. And so, or as often as described in the business, essentially providing banking as a service and embedded banking.
Right. Well, thanks. And what about before you took on this role? What were some of your responsibilities at Seattle Bank, and maybe a little history on your background before joining the bank?
I joined Seattle Bank as Chief Banking Officer and helped build out what we've referred to as our boutique bank. So that's providing private mortgage and commercial banking in the greater Seattle area. So now, while I'm no longer heading the sales and relationship teams for that group, I continue to be involved with the boutique bank from a strategy, product, and marketing standpoint. So I guess put another way, we're still a small bank, and so everyone wears a lot of hats. Prior to joining Seattle Bank, I was at Wells for 16 years, both working directly with business clients and or leading teams that were serving business and commercial clients. I actually started with Wells in Minnesota. After school, I started with what was then Norwest Bank, and then within about a year or two of that, Norwest acquired Wells Fargo, and eventually made my way with the company back out to the Pacific Northwest, which is where I was born and raised. Yeah, so I was with them for about 16 years overall, always working with commercial clients, everything from small business on up to larger corporate clients, working both domestically as well as in their global banking division.
You say that you've had a chance to listen to some of my podcasts. You know, one of the things I like to do towards the beginning, just to get into some personal discussions to get to know you a little better. I see from your LinkedIn account that you devote a lot of your personal time to various nonprofits and outside organizations, that you are currently involved with the Martin Luther King Jr. Scholarship Fund and with HomeSite, a Seattle-based nonprofit focused on affordable home ownership, business development, and community advocacy. Can you please share a little more about these two organizations and maybe what were some of the personal drivers that had you get involved?
The MLK Scholarship Fund is a unique fund nationally in that it's a neighborhood founded and maintained scholarship program. It's been in existence for over 30 years and helped over 400 students by providing both financial and non-financial support to them. And these are mostly Black or historically underrepresented students that are either in the Mount Baker neighborhood of Seattle or some of the surrounding neighborhoods. And so helping them to attend 2 or 4 year colleges. And I've been involved with them for probably 7 or so years. Homesite, as you mentioned, is mostly focused on housing and home ownership, but also is involved in community development more broadly in the Southeast Seattle area, which is where the Mount Baker neighborhood where I live is a part of. I met Homesite CEO Daryl Smith years ago when we were on the board of a different community development corporation that was working in that similar area. And he's a thoughtful leader, put together a great team at Homesite and really doing great work. And so when he asked if I'd be willing to help out on the finance committee, I jumped at the chance and have relatively recently started that over the last year. But it's a great group and excited to get involved there. Yeah, I think the personal drivers, one, hey, I was raised with a pretty strong work ethic, but there was also the expectation that some of that work better be helping other people. I think the issues of education and housing and economic development, these are pretty central issues in terms of, historically in our society, in terms of who gets access to the benefits of what's happening. And I think are going to only be more important in the coming years. So those seem like the right places to be involved in terms of making an impact. And again, in both cases, just great people working there. I'd say the last thing that I just think in general, I've been fortunate to be at organizations that have supported that type of involvement. And I think, I really feel like I've learned a lot working with just seeing how other organizations are approaching other problems, especially being part of today a relatively small financial institution, yet having been a part of one of the largest financial institutions, at least in the US. I have a pretty strong appreciation for the fact that nobody can be all things to all people. We all sort of need to choose a lane or choose an area. And it really is going to take a whole continuum of different types of solutions to the problems that we face. And so I think being involved in organizations like the Scholarship Fund or Homesite is just another great way to stay fresh, think about different ways to solve problems and learn from great people.
Oh, it's always nice to see how people pay it forward. So certainly appreciate you investing your time there. Let's get down to business now. Our discussions today are going to revolve around banking as a service, or BaaS. Can you take a few minutes and explain or share what your definition of banking as a service is, and also how embedded finance, which is a term we always seem to hear when people talk about banking as a service, and how those two things, really relate?
Yeah, I tend to think of banking as a service is where essentially what's happening behind the scenes for primarily fintechs or financial brands that are not banks, for them to be able to provide the solution or service that they want to their end user. So in that sense, the fintech is generally owns the relationship, generally is describing and delivering a solution which is in its essence a financial service or product, but they're still reliant on a bank for access to whether it's payment rails, capital, and importantly, sort of the regulatory framework and rights that go along with being a chartered bank. So that's why I tend to think about banking as a service. Embedded finance or embedded banking, I generally think more of where we're working with a non-financial company, right? So this could just be a brand that doesn't want to be a financial services company. They frankly want as little to do as possible with sort of the various machinations that go along with it. But what they've recognized is in order for them to provide the most value in their service offering or the best experience to their clients, they want to bring some financial solution closer to the client, whether that's payments, financing, or some other type of solution they're trying to solve. So that's, I think, embedded finance versus banking as a service. In both cases, we as a bank are working behind either party as a partner. The difference is banking as a service we generally think of as delivered to or through a financial company or a financial brand, and whereas embedded is usually a non-financial company or non-financial brand.
As I was prepping for our session today, thinking about my career, and I kind of went back to my first job out of college in 1982 when I joined Citicorp Retail Services, where we provided private label credit cards, companies such as Goodyear, Tiffany's, Charming Shops. Thinking about the private label card business, which has now been around for a real long time, could we consider that one of the first banking as a service models that existed?
I like that idea a lot. And I'd be curious to know with Citicorp at that point, it probably was highly vertically integrated. And so I might say that was sort of the earliest embedded banking, right? Because you guys were really doing almost all of it on the Citibank stack and then bringing in those brands that you mentioned on the front end. So I think that's a great example of sort of the earliest notion of that, but also points to the fact that there really is a long history, in fact, of or it's actually more the norm than it is the exception, that behind banks and financial service companies, there's an ecosystem of partners behind them that are often delivering the service. Citicorp back then was pretty rare, and I'm guessing today I'm guessing they have a much more of a broad network behind them that's helping provide that. And so I think it's good to see that in some senses, some of the things that we often talk about as being bank as a service or being these new innovations actually are less of a huge change in structure. I think what's changed now is just that one, actually more software as a service, right, has just opened up the types of combinations that can be made and made it more flexible. And two, it's just created so much more flexibility for differing sizes of companies in terms of how they're going to make those connections. I guess the third thing around that is obviously technology has changed, right? The ability to work in APIs, the ability to work in the cloud has really accelerated how those configurations can come about. But again, I like your sort of analogy or your sort of observation that concept is actually pretty well tested.
And maybe along similar lines, when we think about Prosper and Lending Club, which have now been around for a while, and there was a lot of talk about, well, it's really just a rent to charter, and there were some concerns brought up by some regulators. When we think about BaaS today, is it kind of chapter 2 or chapter 3 of rent to charter, in your opinion?
Yeah, I think so. I mean, I think our view on this has been that the more established players, right, meaning in some ways that was established players like, say, Lending Club, right, which of course now is a bank, once they had size, once they had real enterprise value, I think, and I'm not talking specifically about Lending Club now, but just more broadly, some of the earliest and most successful players from a fintech standpoint or from the neobanking standpoint, they got a lot of traction. They had huge success with customers. And with that, now they've recognized, the risk calculus changes, right? You can't move fast or break things with other people's money or PII. And so I think whether it's chapter 2 or 3, we're definitely in a new chapter where the established players are putting a much higher premium on regulatory compliance, redundancy, security, and things like that. Whereas, maybe before it was just, hey, how do we get this one product or feature to market right away? I just think that has changed. And to your point, I think there's a different thought process happening, both for those established fintechs, but also as we start to think more about that embedded banking and non-financial brands are saying, hey, how could we offer more value to customers? They already bring that level of, they think a lot about counterparty risk, right? They think a lot about not wanting to add new regulatory frameworks to their enterprise. And so when they start thinking about, do we really want to be dealing directly with the CFPB, I think those companies, they're pretty quick to realize they don't. And they want to find financial partners and financial technology companies that bring a real appreciation for that and sort of a discipline around it.
You probably touched on this a little bit, but I was doing a little review of your website, and to the left of the About link, one finds the word fintech. And you go visit other websites, other large banks, and you don't really see that word fintech pop up so predominantly as it does on your website. Maybe give us a little more background on why you've made fintech such a focus of your organization and really have it so predominant on your website on that first page.
Yeah, I think, at the highest level, we came together as a management team, as we mentioned, 8 or so years ago. And I think part of what really drives us and our vision is the recognition that financial services are changing really rapidly. And there's 2 big drivers on that. There are multiple drivers, but 2 big ones. One is technology is evolving very, very quickly in terms of what you can do with it and the ways you can figure and scale. And 2, consumer behavior is also rapidly adapting. And on the one hand, that may seem sort of obvious. And, I think financial services has lagged most industries in terms of digital adoption, and not for necessarily always bad reasons. As I said before, there are certainly risk factors around that. But those 2 things are absolutely driving change in financial services. And our view was the economies of scale still exist, whereas before they really accrued to physical distribution and consumer banking, let's just say, meaning branches. Now they really accrue to digital distribution. And so your ability to have that is critical. But I think initially there was a sense that, hey, technology is going to make it so banks have, it's going to level the playing field. And I think that's only partially true, right? On the one hand, there are a lot of things that we can do differently because of technology today. We have some advantages because we can be nimble as a smaller bank. But let's make no mistake about it, right? Like there are thousands of engineers working at the biggest banks and much more spend, and they are going to have an advantage if it's just a straight drag race, on a specific sort of feature from a tech standpoint. Therefore, the alternative is to then be very, very, so you have to be very big or very different, right? Very,
Right.
have a unique niche, be able to offer something. And we recognized early on that we were going to have to think about technology differently if we were going to achieve the ability to drive new value through differentiation. So that was at the sort of fundamental view of how we thought about it. And so what we then went about doing was really saying, okay, that really does mean we need to have a different tech stack. It doesn't necessarily mean we're going to be fully vertically integrated. We don't own every piece of that, but what components and who we partner with upstream to get the technology that we need, how we fit those together, that goes into every, major business decision that we make. And when we make those, it's not relegated to sort of the IT department or even the CIO or CTO. Our CEO is absolutely involved in those. I'm involved in that. Our CIO, of course, is a critical resource in that. But we really are driving technology into the business decisions the same way that as a bank, you're always driving risk management into the decisions. So I think that's sort of why you see, technology or fintech being a key part of it. And then what we've been able to do by having that mindset is to now start to drive forward where the changes that we made originally in our technology to take better care of our clients in that boutique bank, the private, the mortgage, and the commercial banking clients, we're now able to leverage that technology to go be a partner through banking as a service or embedded banking, as well as starting to develop new consumer-facing technologies and services. So we launched late last year CD Valet as an example, and that's a really new product in the industry. And those are things we can do because that technology is part and parcel of how we run the business.
So when we think about the bank as a service model, there's really four key players, right? You have the customer, which could be a consumer or business, the distributor, such as a fintech or a brand, including companies like Affirm, Chime, the enabler or infrastructure provider, such as a Finastra, a Galileo, and of course, a producer, financial institutions such as Seattle Bank, Evolve Bank, and others. Let's kind of just briefly touch on, each of these. So when we think about Seattle Bank, outsourcing that customer experience and acquisition to a distributor, is the view that may be an area where your distributors do a better job, or is it that it's really just more of a complement to the type of abilities you have to acquire customers?
Sure. I think it could be either, right? I think on the banking as a service side, there could be good examples where some of the earliest players on the lending space, which I know you have a lot of insights into, whether it was SoFi or Lending Club, they really created these highly focused experiences and businesses around originally just single product. And so they really were, I think they did do a better job. Or I think if you look at Chime and how they have taken on consumer banking, specifically targeting segments who are not focused on savings in their account. They're really focused on how quickly they can get their deposit and then how effectively and efficiently they can move that around through debit and other use cases. They did some amazing things, right? And so they, in those cases, I'd say they were better and they pushed the ball forward in that regard. I think more on the, if we're thinking more about the embedded banking or some of the lending opportunities, in that case, the main thing is that the distributor has distribution, right? They already have captive customers. They have them at the point of use or whatever the relevant context is for them to now make a financing decision. And where, most people don't wake up in the morning and say, hey, I think I want to go shopping for a new bank. They might say, I'm going to go shop for a new fill in the blank. And when I do, I'm going to need to pay for that or finance it or whatever that is. And so I think that's where we think the distributor, that complement to us is they've already got access.
So when you partner with a distributor, and we'll get a little later into kind of like your first offering that you're rolling out through us and others, is the ability to get that checking and savings relationship part of your long-term goal as you bring on other distributors?
We take that on a case-by-case basis. I think we're leery of sort of loss leader models. And I think we tend to say, hey, a given business really needs to stand alone for us to put something together. And then we'll determine to the extent there may be, expansion or extension capabilities down the road. So I think from that standpoint, I would say the general answer to that is no. We typically say, let's make sure that for whomever that distributor is, we're providing them the most value for them to go get those customers, right? Because if they already have customers, what we want to do is make sure that they can just sort of, get that flywheel effect, get the next customer, do a great job. And that's what's going to drive down cost of acquisition. That's what's going to drive down cost of service through that model if we can just be really well aligned with what they're trying to do. To the extent that what they're trying to do also has maybe a deposit need in addition to a lending need, well, then of course we're going to want to try to solve that. But I think we try to take those sort of case by case and sort of product by product.
Since we're talking about distributor, can you share with the group what is that first product that you're bringing to the market? If you're allowed to share who the distributor is, that'd be great. And also, what type of due diligence process do you put your distributors through? I think that would be some interesting insight to our audience.
I can definitely share this. So the first one that we're working with GDS team on, there's a handful of players involved, but really the distributor in that case is a company called Lone Star. And what they've basically built is a business working with merchants, primarily small businesses that want to offer their customers financing at the point of sale for things like home improvement, but it's not limited to that. Oftentimes it's things like power sports, but generally larger ticket items than you might typically want to put on a credit card. Also larger ticket items, but also smaller enough merchants that there may not be sort of the use case for sort of what we saw in terms of BNPL or the pay in 4 model. And
Right.
so they've built out a really great network of merchants that are looking for access to lenders, and specifically that lenders that can be highly integrated into the experience that Lone Star is providing those clients, and that integration can support real-time decision making and real-time fulfillment. And so that was really the key there, and ultimately, of course, how we got to work with GDS was really taking. For us, we're a bank, we're longtime lenders. We're used to doing our business historically. Boutique bank side is a relatively small number of very large transactions. And this was really us shifting to say, how do we build out the technology so that we can originate and service at scale and do that in a real-time fashion? And so that's essentially what we built out to be a partner to them. And so the advantage is, they now have customers that, again, at that point of use, they're able to essentially get a real-time offer and then decision and move that forward.
And we certainly appreciate your decision to move forward with GDS. I know on a piece of your BaaS, you've selected Finastra, and it'd be interesting to understand what are some of the key components of your overall BaaS offering that you're picking up from Finastra, and what were some of the touch points that went into that decision?
So Finastra is a key partner to Seattle Bank, no doubt about it. So for folks in the banking space, they're our core provider. So probably 5 years ago, as we really started to formalize the strategic tech plan for the bank, we recognized the need essentially to make sure that our tech stack was cloud-based, real-time, and could be supported by open APIs, and ultimately was in alignment with the idea of open banking. And Finastra ultimately was the player that we saw being most responsive to those criteria. And so we first moved our digital banking experience over to there. And then importantly, literally probably a month before the COVID and then the PPP loan program, we completed a core conversion to move over to their core, which again is unique in that it's for those reasons that I mentioned. Their core is cloud-based, open, real-time, and it has API support. So that was key in selecting them from a technology standpoint. And then the broader thing we always look for in terms of partners is, hey, we need to work with people that have a sense of urgency around the challenges that especially small banks face, but for the reasons I described before in terms of the rapid changes in technology and consumer behavior, we need to have partners that are willing to be entrepreneurial and that can be really aligned with our success. So they did that. That was critical to us selecting them. And a great example of that is as we started to share with them how we thought about banking as a service, that aligned with their vision around these opportunities as well. And so that's the reason that we were brought in as the first bank as they launched their banking as a service lending platform with Lone Star. So in this case, Finastra is really providing the orchestration layer, if you will, between, say, the Lone Star that's facing the customer and the merchant, and then connecting to GDS, who we're using for real-time underwriting, and then other key elements of that value chain, and allowing us to then go and book those and fund those in essentially real time. So yeah, they've been a critical partner to us, and in part because of technology, but in part because of just worldview and a real commitment to hustle and go out and do some new exciting things. So it's been a good partnership with them. And I think to proof and point, they do have a decision engine. In that sense, GDS is a competitor to them. But when we walked through with them the use case that we had, and the real advantages that GDS offered to us, and to the ability for that partnership to work, and really for this lending solution to work, they recognized that made sense. And again, and consistent with the whole idea of open banking, we were able to integrate and use GDS as the best in class solution for that part of it. Finastra is absolutely still benefiting from the overall partnership that we've launched, but in a way that I think we've not historically seen the traditional or the legacy core providers show that sort of commitment to open banking, and that willingness to, even if it means that they're going to bring in another party for a piece of it, and that would essentially is competing with them. They were supportive of us doing that because it was the right thing to do to get to market and drive value for everyone.
Great. Well, I know Finastra and GDS both appreciate your business and the nice words. So in the banking as a service model, when we talk about enablers like a Finastra, they often refer to someone as a program manager who will actually maybe help banks like yourself go out and identify other partners like a Lone Star. In your model, Josh, are you going to have a team that goes out and identifies other distributors, or will you work through the Finastra model, or a combination?
I would say in general, we are driving that ourselves, meaning we're directly reaching out to those partners that we see a good fit with. Of course, in this case, Finastra brought someone to us, and we thought that made a lot of sense. I think you maybe asked before, Rich, and I forgot to cover it, but essentially a key piece to that idea of them bringing somebody to us is we really need to make sure that there's good alignment from any partnership that we're looking at. And we generally tend to say, hey, the first thing is, are they solving a problem for the client, right? Can we all look at this and say, this is a solution that's good for the client and is going to make sense? Assuming the answer to that is yes, then it's really, one, technically, can we do this? Two, from a compliance standpoint, is it legal? And three, can we all make money? I think particularly in the case of Lone Star, what we really liked about them as a partner, and especially as the sort of inaugural partner for the program that Finastra was putting together, is they brought a really strong compliance mindset to that. And so they absolutely anticipated the types of questions that we were going to ask and the diligence that we needed to do. And so in that sense, we're open to, of course, anybody suggesting potential partners to us, but we take much more of an active model than I think is sometimes the case, where there are what I would describe as non-bank banking as a service providers in the market. And they may have a cadre of banks that have said, yes, let's sign up. But a part of their value proposition often is to the banks, hey, we'll do a lot of this selection for you. And I think that has some intuitive value to it. To us, our sense is that it's difficult to have any middleman when it comes down to those real brass tacks around the compliance and the risk structure. And so that was part of why it worked well with Finastra, is hey, we're going to make the introduction, but Seattle Bank, you're going to do all the diligence from a vendor or counterparty standpoint, as well as on the overall product and delivery framework.
When we think about your relationship with Lone Star, then I think about things like marketing, credit policy, compliance, customer service, collections. Can you kind of touch on how that structure is set up, and how much, for example, influence or participation does a Lone Star have, let's say, in credit policy?
Well, in terms of credit policy, we 100% own the credit policy. And so I would say, we certainly might say to them, what are you seeing in the market? Where are you seeing sort of pain points, or what are some of the trade-offs, as we just think about, as you would do it anytime you're looking at risk management. But we're 100% deciding this is the product framework, geography, product type, and then all of the credit terms that we're going to be making these decisions on. We're entirely making the decision, which is why we're using GDS, right? Because by the time what happens is we essentially get an application. Oftentimes there's some degree of pre-qualification that's gone into that to try to just figure out which are the right banks to get involved. But once we get that, we're absolutely doing the underwriting, making the decision, and that's entirely on us from that side. Yeah, so I guess more high level, generally in that scenario, they're doing all of the advertising and they're not advertising Seattle Bank, right? In most cases, this is a merchant advertising, hey, here's a home improvement solution. And then if you would like financing, essentially, here's an option for it, and it works its way through to the bank. The user interface from a lending standpoint is provided by Lone Star, so they invested in that technology, and they're the ones that are making that available both to the merchant and to the actual consumer who's applying. And then really once an application comes through that system, and we've worked with them, and as I said, they had a really strong program already. There were a handful of things where we worked with them to say, hey, we'd like to have this disclosure or this language or things like that to make sure it was consistent with our view on that. And they've been great to work with there. But otherwise, they're really collecting the application and the needed material or the information that we need. They're delivering that all to us via API. Some of that is getting pulled out from our, BSA or know your customer, things that we might be doing. Some of that's being, but the majority of it, as your team well knows, is then getting pushed into GDS where we're doing the decisioning on that. So that's, and then at that point, once it's, once docs are pushed out and the customer has been able to complete that via e-sign, they're now our customer. They're getting a welcome from us, and at that point, we service them from there on out in terms of any questions or issues that they have, providing statements, online access, payoffs, etc.
At a high level, can you share the economic model that exists between you and the distributor and you and the enabler? Don't give us details, but just like high level, what's the structure? Yeah.
I think the simplest way to think about it is we're paying some version of a commission on loans, in this case, that are actually originated. So we're essentially saying, hey, here's a percentage of that that's then shared out between those players.
I was reading a report, 2021 report by CCG Insights, and it said in 2020, in the U.S., there were 42 bank partners involved with BaaS, and they forecast the number to grow to 75 in 2025 and 110 by 2030. As other financial institutions step into the BaaS model, what do you feel might be some of the key factors that will drive success for banks, and what are some of the things that you think could impact them negatively?
In terms of on the success side, it's about the banks that really have a clear vision going in of where they see their value proposition, what are the strengths that they have to play to, so then where they're going to focus that approach, right? There's banking as a service could be on the lending side, it could be the deposit side, could be on the payment side, and each brings its own challenges. And so I think one, having clarity around just where the area of focus is. Two, it's taking an assessment of a bank's existing capabilities. And some of that is technical in terms of, as I was talking about, our tech stack and some of the things that we've worked towards it literally over a number of years to build out. But now that we really do have a configurable, scalable technology infrastructure that allows us to be really responsive to different types of opportunities. We're fortunate to be in that place today, but it took years to get there and a high degree of commitment by the bank. As I said, from CEO on down, and I should say, for that matter, support from the board to make those types of decisions, and then finding the right partners. So there's the tech side of that, there's the cultural side of that, and I think the other element of that cultural or talent side of that is having people on the team that, I'm not a technologist, but I know enough to be able to think through what are the implications of one model over another, as an example. Another piece of it, though, is as we do become more configurable, and we can become more configurable because there are more options out there, our ability to manage third parties is critical. We came to that. A lot of our, in addition to the boutique bank that I described, we have an asset generation business where we're less originating, but more buying assets. And we're one of the largest players in the reverse mortgage space.
Oh, wow.
And the critical piece of that business is, our team is one of the leading teams in managing sub-servicers. So that's all about the clearly understanding the client, what they're trying to do with the reverse mortgage, understanding the idiosyncrasies of reverse mortgages because they are unique, right? Everything's backwards. And then really understanding, the roles and responsibilities with our servicers who are having that day-to-day contact relative to, the regulatory requirements. So we were fortunate to bring a really high degree of competency around how you manage third parties and what to manage them to. And that's been critical to, to the success in building out this banking as a service model. I think the failures are going to be the reverse of that, right? And we've seen some of this already, but essentially, under indexing on the importance of regulatory compliance and consumer protection. It's easy to want to run and with the fintechs or run with the Silicon Valley sort of like pace, but the reality is we just have a different set of criteria and grounding as chartered banks. And I think the banks that don't commit to that, don't manage expectations of their partners effectively, and then ultimately don't build programs that have alignment and accountability around that, they're going to be the banks that find this to just not be productive and at worst, to be a potentially very risky venture.
So for our potential distributors that are listening to this podcast, what would be the top 3 things that you would tell them they need to think about if they want to come to you and talk about a partnership?
I talked about the big questions we ask as we look at one. So I think that's back to that. Hey, assuming that it's a good solution for the client, can we do it? Is it legal? Can we all make money? Right? I don't think that the distributors or partners need to know the answers to all those. I think the question is, one, really being clear from their standpoint, what are they trying to achieve in their business? Where's the strategic value in their mind of bringing in either a partner to help them with some embedded financial solution, or if this is a fintech, they're looking at either a new partner or a new product. What's the strategic value that they're trying to achieve? Because I think that then helps put into much more stark contrast what trade-offs are going to make sense. I think having that first is important. And then I think it's looking at, as the partners that you start to talk to, do you feel like there is an appreciation of those factors? Too often what we see is players that have gone out and optimized for one variable, and we just don't have that option, right? You can't just optimize for technology and how slick it is, and you can't just optimize for compliance, right? And I think, as I know you're a career lender, and I know you had a lot of background in collections and monitoring and managing collections teams. Hey, the reality is we have to optimize for more than one variable in banking and risk management. And so I think it's making sure that you're talking to partners who show that appreciation. And, oftentimes the people that are saying, hey, we can do it in, weeks, not months, or days, not weeks, that's probably a little bit of a red flag depending on the complexity of what's involved.
Well, maybe the B in BaaS also stands for balance as well as banking, right? Finding that right balance. So in 2019, Angela Strange said that every company will be a fintech company, driving home the point that banking isn't just for banks anymore. What are your thoughts on the statement? And do you think maybe it's an overreach?
I have a lot of respect for Angela Strange. I enjoy her work, and of course, their firm has a great track record. I don't agree with the statement. I mean, I think probably the gist of it is probably right in that every company should be thinking about how they make their experience evolve with the evolution and that's made possible by fintech. But I actually don't think this makes sense. Literally, I think the point is many companies they don't want to be financial services companies. They don't want to have to worry about what is UDAP or what is fair lending or disparate impact or disparate treatment. We're a bank. We have people that literally wake up in the morning wanting to go solve UDAP, right? Unfair, deceptive, active acts and practices, right? Or fair lending concerns. So I think it's sort of the other way around, is that it really, the general, I think, direction she was referring to is that banking is going to be more integrated in more and more customer experiences. But the way to do that is for non-financial companies to partner and to partner well with companies that can help deliver really durable solutions into that experience.
Well, great. This has been extremely informative, Josh. And I'm going to throw one more out on you. If you had to write a book tomorrow, what would you write about?
Yeah, that's a good question. Honestly, I think the thing, if I could start by first going back, Rich, to go to do more graduate work,
Okay.
and then it could lead to a book. I think the most interesting to me is to really look at how do communities and economies effectively build wealth for people, right? And
Hmm.
especially that it not be ideally that it be more equitably distributed. And I think my kids probably would make fun of me and say I'm a neoliberal, but I am a student of economics, right? I do think markets work, but I also think Adam Smith said it's our enlightened self-interest that's going to drive good outcomes. So I do think, I've worked with businesses pretty much my whole career, well over 20, 25 years of companies that are, providing value to our communities, providing jobs, doing all these things. And so what are the structures and what are the resources that we could put together to drive for better outcomes, right? And I do think
Yeah.
if you get down to it, how do communities, whether that's geographically, but also if you look at other types of communities, how do they build wealth? And I don't mean wealth so they can just go have ostentatious spending, but wealth so they can invest in education, invest in their in their families, and sort of do good things. I think that's one of the more interesting questions out there, and that's probably what I'd do if I could do anything else. I'd go try to figure out that.
Well, that's pretty admirable. Certainly, one place we could start is financial literacy, right? It's nice to see that some states are finally adopting a policy that you have to have financial literacy to graduate from high school, but it's few and far between. And I think that's a big problem we're facing today is that a lot of the younger population, even some of our peers, are not really educated financially. And I think that's a place we can start. But Josh, I want to thank you for your time today. This is Rich Alterman, and we've been syncing up with Josh Williams, Head of Banking Partnerships for Seattle Bank. We hope you've all enjoyed the podcast. Please stay connected with GDS Link and the Lending Link to listen to future podcasts, catch up ones you've missed. Thank you, and that's a wrap. Thanks for listening. If you've enjoyed today's episode, please be sure to subscribe on Apple, Spotify, Google, or wherever you listen to your podcasts. And be sure to leave us a review. Follow us on LinkedIn and connect with us on Twitter at GDS Link. That's at GDSLINK. Have a question for the show or have a specific topic you want us to cover? Hit the link in the description to drop us a note. Thank you for lending us part of your day. Make it a great one.